Hello, everybody. It is Jason Greenwood with you again today. Happy Friday to you. It is at the Coalface Live, my weekly live news show where I cover off the top e-com and digital and tech news of the week and give you my take on things. It is the 27th of August today, 4 p.m. New Zealand time, as I come to you every single week at this time. Super excited to be with you. It has been a super busy week for me. It's been a super busy week in e-commerce, despite the fact that we are back in level 4 lockdowns here in New Zealand, which is kind of the heaviest, most onerous level of lockdown that we have available in this country, which is pretty much you can't go anywhere except for to the supermarket and walking and exercising in your local neighborhood. So we're still under those crazy lockdowns, but those of us that work in the digital space and who have consistently worked remote for a very long time, it is pretty much business as usual, and it is absolutely business as usual for me. I've been crazy busy this week working on client projects. It's super exciting. I managed also to record 4 podcast interviews this week with some amazing guests that are going to come out over the next 4 weeks. I'm super pumped about that, and just there's so much going on in the space. It is a very, very exciting time to be in digital. And obviously, as these rolling lockdowns continue in Australia and New Zealand, it is continuing to put a rocket up the backside of e-commerce, and it is forcing businesses to continue to revisit what digital and e-commerce capabilities they have or don't have, as the case may be. And so therefore, I'm getting more inquiries than ever before from brands wanting to go online, wanting to improve their e-commerce experience, wanting to re-platform, look at their tech stack, make sure that they're providing the best e-commerce experience possible to their customers. So, that quote unquote expected slowdown in e-commerce demand that a lot of people forecast, a lot of pundits forecasted for 2021 versus 2020 just simply has not eventuated. E-commerce has remained very, very sticky as a method of purchasing and a method of buying by consumers. And with particularly with the Delta variant, and particularly with the hell-bent nature of our government seeming to want to lock down at the sniff of COVID, it's continuing to drive massive, massive e-commerce demand across B2B, B2C, and everything else. So that slowdown has never eventuated. It is busier than ever in the e-commerce space, and I'm super proud and happy and lucky and blessed to be working in the space, and super happy to be with you here today. So super cool to be with you. And as per usual, I will run through the of the week with you, and then at the end, I'll jump back into your comments and your questions. I treat this almost like an ask me anything type of scenario, or comment anything type of scenario in my lives every single week. And so therefore, if you pop a comment or a question in the LinkedIn Live, the Facebook Live, or the YouTube Live. In fact, I'm not even sure if the YouTube comments come through directly to me, but I certainly know Facebook Live, LinkedIn Live, comments come straight through to me here in StreamYard, and I'll be able to respond to those at the end of the session together. So the first piece of news that I'd like to talk about today is a super exciting piece of news for New Zealand. It is not specifically e-commerce or digital related, but it is tech related. And that is the news that Rocket Lab, based here in New Zealand, debuted on the NASDAQ in the United States with a valuation of $5.2 billion. Now, those of you that live outside of Australia and New Zealand probably haven't necessarily heard of Rocket Lab. You know all of the space exploration exploits of the Playboy billionaires of the world, such as Jeff Bezos and obviously Elon Musk, and all of the other Playboy billionaires that seem to want to get into space and get off this rock we call planet Earth. But there is a Kiwi competitor to these rocket building, interplanetary focused companies, and that is Rocket Lab of New Zealand. Now, they said that they were valued at 5.2 billion, New Zealand 7.4 billion. This was effectively by acquisition by a shell company. It was already listed on the NASDAQ. And the share price closed at $10.43 after opening at $11.58. About 5.6 million shares worth, or just under 60 million US changed hands on the first day of trading. And really, Rocket Lab, I think, is indicative of how Kiwi companies oftentimes punch well above their weight internationally. And we can look at companies like Vend, we can look at companies like Zero, we can look at companies like Soul Machines, we can look at companies like Allbirds, we can look at so many Kiwi founded, Kiwi built, Kiwi ingenuity driven businesses that have taken on the world in their respective markets, have footed it with the best in the world, have dominated in their individual categories, and have ultimately, in the case of Vend and Zero, been snapped up by international players because of their successes and their challenger status on the international stage. So, and then in the case of Allbirds, obviously Amazon copying famously their shoes, but not necessarily copying their sustainability efforts. So I think Rocket Lab is simply indicative of this Kiwi mindset that, hey, we're a small country, sure, on the very bottom of the world, many, many hours away from anywhere significant in the world. However, we have a lot of Kiwi ingenuity. There's a lot of technical prowess in this country, a lot of development prowess in this country, a lot of software engineering prowess in this country. And I am personally, as a dual citizen, Kiwi American, and having lived in New Zealand for 25 years, this listing by Rocket Lab makes me an extremely proud Kiwi, and I wish them very, very well. Obviously, the founders and early investors in the company, most of their staff are now sort of instant millionaires, and obviously founder now pretty nearly a billionaire. So congratulations to them, and I wish them all of the very best. Now, Power Retail, which is an Australian market research company specifically focused on e-commerce, they've released their latest trajectory report, which is a fortnightly or a 2-weekly report, which is drawn, and they say specifically that they draw from aggregate anonymized benchmarking data of over 10 million online user sessions per month, from a broad cross-section of Australian online retailers, plus fortnightly survey data, so qualitative data collected from a panel over 1 million online shoppers. So their trend data tends to be more accurate than most, and their report found that almost half of all online shoppers, or 46%, are more comfortable shopping online than last year, and this is higher than the 42% who said that they have long been comfortable with shopping online. So we're talking about people that were already shopping online anyway, and of that cohort of online shoppers, 46% are now more comfortable shopping online even than last year, which is surprising, which just shows that upward trajectory of online purchasing demand continuing to grow. They also said that half of all online shoppers have increased their online spend in 2021. And this sort of counters some of the concerns that 2020 was a bumper year for e-commerce. Many online shopping penetration records were broken last year, and there was a lot of concern that would not continue into 2021 as the pandemic came to an end and as physical retail reopened, and that is simply not the case. It says 68% of online shoppers said they increased their level of online spend last year, but we're still seeing the majority of those continue to increase their level of online spend on top of that heightened 2020 number into 2021. And a third of online shoppers, or 33%, have maintained their level of spend online, which again, given how crazy 2020 was in its own right, is just phenomenal. And so there's only a very small minority, which is they quote it's around 17%, that have decreased their spend online 2021 versus 2020. And I guess again, there was a lot of pundits, industry pundits, and even some of the banks and even some of the carton carriers, so some of the logistics players were forecasting a significant drop in 2021 versus 2020 in e-commerce. That is simply not eventuated. So the demand I'm seeing from merchants, B2B, B2C, D2C, the demand I'm seeing for merchants to upgrade their online shopping experience or introduce online shopping for the very, very first time for their brand is continuing to grow. It is like trying to drink out of a fire hose. If you are worth your salt in digital today and you are not busy, then you probably have something to be worried about. Because if you are good at all, you are probably busier than you have ever been in this space. One of the final call outs that they made is that over 71% of online shoppers prefer to purchase online rather than in store. Now, this has increased in the last year up from 62%. So from 62% to 71%. And on the flip side of the coin, naturally, this means that the number of online shoppers who prefer to shop in store, but for example, may have been forced to shop online during the pandemic, that has actually dropped from 38% in 2020 to 29% in 2021. So this means that people are electively choosing to shop online, pandemic, no pandemic, which means that bodes well for 2021 end of year growth and 2022 growth as well. So super exciting times to be in the space. Now, next piece of news that I'd like to address is that Shopify and TikTok have announced a deepening partnership. They've had an existing partnership for a while now. However, they've expanded their partnership, and this only applies to merchants it's actually a beta phase, to some select merchants in the US, UK, and Canada, to where the integration is deeper between the Shopify platform and the TikTok platform from an e-commerce perspective. So what does this do? Well, it makes it easier for Shopify merchants to list their products on TikTok. It allows merchants to create virtual storefronts inside of TikTok as a tab inside of their profile. So when you go inside that business's TikTok profile, there'll be actually a storefront tab or a shopping tab there. It also allows merchants to link to products from their catalog in their organic TikTok posts. However, and this is a point of confusion that I've seen talked about online a little bit since this got announced a couple of days ago, no, it does not mean that TikTok doesn't supports in-app purchasing yet in the West. It does not. And I think that the actual post from Shopify about this was a little bit misleading in that it talks about in-app shopping, but not in-app purchasing. And there is a distinct difference between the two, but to non-technical people out there, your standard consumer in the street, they might not understand the difference between in-app shopping and in-app purchasing. So at the moment, what this integration facilitates is a direct integration between the Shopify catalog and TikTok. But what happens is when the customer adds it to their cart or follows a link from an organic post to the product, what it does is it redirects to the merchant site so that they can complete the checkout in Shopify native checkout for that product. So there's still a ton of friction involved. We know that TikTok can do this. Their Douyin counterpart in China, which is the TikTok equivalent in China app, they facilitate full end-to-end in-app purchasing. So you never have to leave your social stream to complete that purchase. Does not happen in TikTok yet. Obviously, there's a lot of tax implications. There's a lot of cross-border commerce implications. The West is very fragmented in terms of currencies and taxes and legal ramifications. So, they're trying to thread that needle a little bit here. But I think that until in-app purchasing is enabled in TikTok, there's still going to be a heck of a lot of friction in that sort of blending that content and commerce experience on the TikTok platform. But it is a step forward in the right direction. Now, next piece of news is a pretty interesting one. And when I read about this, I had to do a little bit of research into what Tuna actually was, because I didn't actually understand what it was when I read this article, and it took me a little bit of time to wrap my head around it. So Tuna is effectively an e-commerce payments facilitator slash fintech slash anti-fraud testing platform. Now they've raised $3 million, and they target Latin America specifically. They were started in 2019, and the idea behind Tuna was to make a payment product or a payment plugin that it allows merchants to test or A/B test or multivariate test credit card processors, anti-fraud technology providers, so that they can optimize their payment processing with one integration as well as no code, according to Tuna. Now, what they said and again, this is the part that I didn't fully appreciate until I read this article, was that the address verification system that merchants use across LATAM or Latin America that verifies a customer is who they say they are. It involves sending information to a bank that is returned to the merchant with a score of whether that match is legitimate. Now, in the United States, these scores are sort of socialized across multiple companies and across multiple providers. Now, what they said is that merchants in LATAM have to tap into other organizations that have that centralized data set. Now, what happens is that with Tuna is that the process involves a manual analysis and constant adjusting, or sorry, pre-Tuna, without Tuna. What that means for merchants is that they have to manually analyze and adjust due to fraud, depending on what the fraud scores are, and raise or increase or decrease their fraud based on basically the volume of fraud that's coming through at any given point in time. Now, that is extremely inefficient, and it can allow fraud to slip through or artificially increase decline rates. And so what they say is that they basically automate this entire process, and it creates an objective data set that is merchant specific and category specific that allows them to accept a higher percentage of payments and a higher percentage of orders, while also simultaneously reducing fraud by A/B testing these different systems against each other in real-time scenarios on a given website. So pretty amazing technology, and they were pretty proud about some of the platforms that they've integrated with, as well as the customers that they've taken on. They said that over the last year, they've added 12 significant customers. They've seen their revenue increase 15%, and they have some very, very large Brazilian clients, existing Brazilian clients, Riachuelo, and they have integrated now their platform with Vtex, Magento, and WooCommerce. And I've spoken about Vtex extensively in the past, and I have a very, very big surprise for you coming up on the podcast in relation to Vtex within the next couple of episodes. So keep your eye out for that one. Now, the next one is that Adobe has reported that e-commerce inflation is not slowing down at all. Online prices were up 3.1% in July. So what they said is that's month over month, so July versus June, and that outpaces the 2.3% year over year increase in June. Now, they say that Adobe began reporting on online price trends only from June, and the reason that they did this is they were seeing a dramatic reversal of 5-year patterns of annual price decreases, and they wanted to report on that specifically back to the market. So there's a combination of factors that they've mentioned and that I'm noticing in the market that have contributed to online price inflation being quite dramatic over the last, say, 6 months. And that is lockdowns forcing more and more people to shop online. So the demand across these websites has skyrocketed. Global supply chain issues and demand far outstripping supply has meant that merchants are having to spend a lot more. And in many cases, they are shifting away from sea freight to air freight to get their products in a timely fashion so that they can get them out to their customers in timely fashion. Now, obviously, air freight significantly more expensive than sea freight. And even in cases where they can continue to use sea freight for freight, the cost of containers and shipping has gone up 3, 4, 5, and 6 times in many instances, depending on the country of origin and destination. And we're seeing that be reflected in the price of online goods going through the roof to compensate so that businesses can remain profitable as they continue to sell online at ever greater numbers. So this is not surprising to me in the slightest, but now we have the hard data to back that up from Adobe. So pretty incredible numbers that are coming out, and we'll see next month when Adobe releases their numbers of just how bad or good August was in relation to July. Now, the next piece of news is that Woolworths, which is one of the duopoly, the grocery duopoly down here in ANZ, they have their countdown chain in New Zealand and in Australia. They're just called Woolworths, but they are under the Woolworths umbrella. And they have recently reported their financial year 2021 results, and their e-commerce sales jumped a whopping 58% year over year. Now, that is phenomenal. And what they said is that the after-tax profit was just shy. Now, this is profit of Australia, 2 billion AUD. That is just a phenomenal, scary number made off of the grocery sector. Now, what they said is that the e-commerce sales jumped to 58%, as I said, and that increase resulted in a total sales online of $5.6 billion. and it was driven by their Woolies X, or the digital arm of the business, which increased 75% from Australia 2 billion to Australia 3.5 billion during the full year period. And they attributed the growth in e-commerce to the ongoing investment it continued to make in digital and e-commerce channels. Well, that's fantastic. And of course, you'd expect a company like this with billions of dollars of revenue to blow their own horn around the digital initiatives and capabilities. However, I would attribute a significant percentage of that growth to the ongoing lockdowns across Australia and New Zealand and the forced buying online in many cases. Sure, these grocery businesses are considered essential services, and so therefore you can still walk into a physical grocery store if you want to, but a lot of people are so paranoid about COVID that they will only shop online. So it makes absolute sense that their online sales would absolutely go through the roof. Makes complete sense. So they called out one final statistic that I thought was pretty impressive. The company managed to increase weekly visits across its web and app platform by 26% to just over 12 million visits per week, and increased its everyday rewards members by 6% to 13.1 million rewards members. Wow, phenomenal number. Now, the final piece of news that I do want to talk about today is the drama associated with OnlyFans. Now, as you know, OnlyFans, the subscription-based platform that is largely driven by pornography or individual content creators, largely, oftentimes female, according to OnlyFans, trying to effectively carve out a subscription-based revenue for themselves by putting out pornography, or at least nudes or whatever it might be, on the internet as a subscription-based service for their fans. They drive a lot of business for themselves by putting up safe for work pictures on something like Instagram and then saying, hey, if you want the full version of me, then go and subscribe to my OnlyFans. I'm sure you've seen this all across the internet. Well, earlier in the week, OnlyFans said that that their payment processors were putting pressure on them to ban certain types of content from their platform, explicit pornographic acts. So pornographic material wasn't explicitly banned. It wasn't really clear from their announcement what they were and what they weren't banning, but they called out specifically that sex acts, so in other words, actual sex or simulated sex, was not going to be able to be videoed and shown on their platform, but that, say, for example, nude imagery was probably still going to be allowed on their platform. So it was a little bit murky on exactly what they were banning versus what they weren't banning, but they were blaming it on their payment processors and ultimately the merchant banks that back them for their decision. Now, there was some talk in the community about the fact that they want to go public next year. They're a multi-billion-dollar a year business. They take 20% commission on everything that their creators on the platform make through those subscriptions, and so they're multi-billion-dollar business based in the UK. And what they said is that they, or what many pundits said was, look, as a result of them wanting to go public and also looking potentially for VC money out in the market, and a lot of VCs not preparing to invest in anything that is considered a vice. So in other words, no porn, nothing to do with CBD, nothing, no questionable type of businesses, no gambling, things like that. A lot of VCs and a lot of investment firms and a lot of private equity businesses have no vice clauses as part of their investment plans, and in the way that they pitch themselves to other investors that invest into them in terms of investment companies. They will have no vice clauses quite often, and OnlyFans fit fairly and squarely under that vice umbrella, and therefore they couldn't go out to market as openly for funding or buyouts, etc., as they could if they were a non-vice platform. So there was a whole lot of drama about this going on earlier in the week. They saw a mass exodus of their creators from the platform. They saw mass complaints, very public outcry against this, cries about censorship on their platform, and we're already seeing incredible cases of censorship across all of Facebook's properties, Facebook, Instagram, and we're also seeing massive censorship and deplatforming on YouTube and many other major platforms out there, creator platforms in the market. And so they were sort of being lumped underneath this ban of censorship that has made its way around the internet, and the boomerang effect of that banging around the internet. And obviously they saw their revenues potentially falling off a cliff as a result of this. So as of, I think it was late yesterday, they announced a backtracking of this decision, and they said that they've sought and received reassurances from their banking and payments infrastructure providers that they will not be cut off from being able to process payments on behalf of their creators on the platform, and be cut off from being able to take subscription payments from the end customers who are consuming this content. And as a result of that, they've backtracked on their decision to ban these types of content from the platform, and they said they've temporarily paused that plan. So they haven't outright said that they will never do this, but they've said for the time being that's the case. Now we've seen Tyga come out with announce his own platform to compete with OnlyFans. We've seen other platforms that already compete with OnlyFans courting all of these creators that were on OnlyFans, saying we will never do to you what OnlyFans did, even if it was only a threat. So come and move over to our platform instead. So what this really signals is this idea of censorship online being concentrated in fewer and fewer hands. So we've got the major platform vendors, i.e. Facebook and Google, starting to censor heavily content across their platforms. And then we've got the payment processors, the payment infrastructure providers, the major international merchant banks, basically being the auditor of what is moral and right for a society to be able to participate in and talk about. So it is a very slippery slope. I am not a fan of this. I'm not a fan of this at all. Obviously, if you're doing something illegal as a platform, if you're involved in child trafficking, or you're you're involved in pedophilia or producing pedophilic content or something like that, and you're breaching law, then absolutely you should be shut down. You should be fined. You should be blasted out of business, and everyone prosecuted to the nth degree. But if you are not breaking the law and you are simply going against perhaps the moral boundaries of a given bank or a given platform, that to me, and if you're being cut off and effectively deplatformed, and through some woke activity by a bank, you're effectively cut off from participating in the international economy. That to me is a very, very slippery slope. We're already seeing it today with the likes of the CBD industry, and the entire, even the legitimate CBD industry, having a really difficult time finding payment processors, credit card processors, and payment gateways that will work with them in their industry. And I think this is a very, very dangerous precedent. So I really hope that this backtracking by OnlyFans is a example of the world getting some sense of normalcy back, where not everybody, this cancel culture has just taken hold and it's gone mad. So it's my hope that this cancel culture will be walked back a little bit, and we'll get back to some sort of sense of fair play and justice in business and in life. So hopefully that's what it's signaling. Now, final couple of announcements are that, as per usual, every single Thursday, so this past Thursday, yesterday, episode 93 of the podcast dropped, and I had an amazing interview with Jonathan Tilley, or John Tilley from Zon Guru, episode 93. So I'm closing in on the elusive episode 100 of the podcast. Super, super stoked about that. I've got about 5 interviews in the can already that will be rolling out over the next 4 to 5 weeks. Super excited about that. So if you are not a subscriber to the At the Coalface podcast, you can get it anywhere you get your podcasts, any platform you get your podcasts. That's where we are. Please subscribe, please like, please comment, please share. If you like what we're talking about, I try to bring a unique perspective to the e-commerce space. There's hundreds of e-commerce podcasts out there, but I'm really trying to bring my unique flavor, my unique experience, my unique question and answer period with these guests. I'm trying to bring a new perspective to the market that perhaps no one else is. I've been in this space for over 20 years, so I've got a unique perspective. I'm trying to bring value to you guys through the podcast. Now, as you know, unfortunately, last week, the Retail Global NZ conference was canceled due to lockdowns in New Zealand, and we all had to rush back home again, in my case, from Queenstown to Auckland in a 24-hour period. However, the virtual version of the conference did go ahead this week on Monday and Tuesday. I was involved in, I think, 4 different sessions over 2 days. was a fantastic time. Not as good as being there. I will not lie. I miss hanging out with my friends. I miss having a drink with a mate. I miss, going out to dinner with people. I miss that physical experience. However, we all did the best that we could, and shout out to Retail Global for making this happen in a virtual way. And so I think I think you can still buy access to all of that content after the fact. So just go to the Retail Global Aotearoa website. Just Google Retail Global New Zealand, and you'll be able to find that website. And I think you can actually still buy access after the fact to all of the tracks over those 2 days, Monday and Tuesday. So had a fantastic time. We talked about a lot of things. We covered a lot of ground, and there was a lot of great speakers over the 2 days. So go and check that out. Now, it is 4:31, so we're coming to the end of our time together. Matthew Rinkert, thank you very much for joining us. You rightly point out Weta Labs, absolutely, punching well above their weight. I guess either merged or bought out by LucasArts. You're absolutely right. Weta, based out of Wellington. Phenomenal international business in terms of special effects and movie production. Absolutely phenomenal. Ann Clark, thank you very much for joining me. I custom make one of my products in China and always fly it in. My delivery times are way ahead of my competitors. Therefore, I'm getting more sales based on delivery. Well, you are not alone there. I think any brand that has managed to either diversify their supply chain or strike preferential deals with their logistics providers, their manufacturers, etc., those brands and those businesses are not only winning, but are going to continue to win, particularly over the next 12 months as online purchasing continues to remain elevated and this distribution and diffusion of businesses continues. So good on you. You've obviously positioned your business to capitalize on this increased demand. So very well done. I can only congratulate you. Absolutely awesome. Matthew, you asked, you mentioned dual citizenship. Are you both a Yankee and a Kiwi? Yes, I am. I am a dual New Zealand American citizen. And the way that I was able to get my New Zealand citizenship is that my grandfather was a Kiwi. My parents, my sister, and myself are dual citizens. That's how I was able to get my citizenship in New Zealand, was because of bloodline, basically. So, yeah, I guess I've got kind of the best of both worlds, so to speak. So I'm very happy to be here in New Zealand, and it's a little bit gray and cold outside today because we're still technically in winter time, but we're just about ready to come into spring now. So I'm very much looking forward to that and looking for a little bit less rain than what we've been having recently. So seriously looking forward to spring and summer, that's for sure. Valentine, awesome to see you pop in as well. 7:41 in Bucharest, and thanks for sharing your unique flavor during my breakfast. 7:41 a.m. God, early in the morning, man. You're getting after it early. Awesome to have you along for the ride today. Really appreciate it. Cool to see you here. Who will challenge Amazon? Matthew. I constantly hear of Mercado Libre and Latam to be a good stock investment. Yeah, Mercado Libre, I've spoken about this on a couple of previous lives where they've done some pretty amazing integrations with e-commerce platforms. Their last major announcement was their integration with BigCommerce to make it really easy for BigCommerce to merchants to list on Mercado Libre and then, pull down those orders into BigCommerce for fulfillment, and then pushing that fulfillment information from BigCommerce back out into the Mercado Libre platform. So they're definitely making some big plays. I actually think that the dark horse here is probably Walmart. As Amazon continues to dominate, as it continues to be a frenemy with its merchants, as it continues to cherry pick categories where it's going to take that vast amount of customer data that it has and sales data and compete with its merchants more and more, either by selling those third-party brands directly to customers, those CPG products, for example, and also continue to build its own Amazon branded products and white label products in competition with other third-party retailers on its platform. Look, Amazon is the 800-pound gorilla in the space. 50 cents of every American e-commerce dollar flows through Amazon. Are they going to go away anytime soon? Absolutely not. However, Walmart has announced recently, I think it was about 2 weeks ago, they announced they've literally doubled the amount of merchants on their marketplace over the last 12 months. Now, they admitted that only about 35 to 40% of those are actually active on the platform, but they're now up to 100,000 registered merchants on their marketplace platform. They've recently done new deals with Shopify, BigCommerce, and a couple of others. And Walmart has recently done a deal with Adobe Commerce where they are effectively integrating their omni-channel commerce technology into Adobe Commerce so that smaller merchants and smaller brands can leverage their omni-channel commerce technology to facilitate things like click and collect, ship from store, distributed order management, and the like. So, look, Walmart is making big moves. You know, you wouldn't traditionally think, I guess, that they could ever foot it against Amazon in an open marketplace scenario, but they certainly have deep pockets, and they certainly are making big noises in that way. And I think if they can bring together more value to be part of their holistic offer, much like Amazon has done with Prime. I think if Walmart can get their act together and they can bring together enough value for shoppers to continue to buy through their marketplace, then they will continue to steal market share. So I would say Walmart has as good a chance as any. And obviously they do own Jet.com. You're absolutely right. So huge moves by Walmart in the space. Thank you, everybody, for joining me today. It has been awesome to be with you. As always, I love joining you guys every single week. I love the interaction with you guys. I love the questions. So keep them coming. And I will see you here next Friday, 4 p.m. New Zealand time. Put it in your calendars. And I can't wait to hang out with you guys next week. So have a fantastic rest of your morning in the case of Valentin, and wherever else you're located, the rest of your day, your afternoon, your weekend. And I will catch up with you guys next week. Catch you guys. Bye.